So there you go.
All right.
I would have thought it was a much bigger deal.
I mean, I simply asked, is there like some function on Bloomberg where I can find, overseas revenue, how it's
See, clients have to
impacted?
pay for getting what you just got from Gina.
I just gave it away for free.
Yeah, well, so did she. But, it's... You never, ever hear me do that. I get paid for every time. Trust me, my friend. Nothing for free. Jackie Bowie joins us. She's a managing partner and head of EMEA at Chatham Financial. Jackie, investors here and folks here in the States, we kind of feel like our economy's okay. Inflation, we like inflation to come down a little bit more. Higher rates are hurting, particularly if you want to go out and buy a house. But generally, things are okay here. People feel like, I think generally things are kind of in the right direction. But Europe, not so much. Talk to us about kind of the economic backdrop that European investors and investors that invest in EMEA over in Europe and emerging markets, what are they dealing with?
Well, I guess the trends are very similar around, higher inflation, higher interest rates, and a concern that those interest rates are starting to impact the real economy. I think the differences in Europe and in the UK is that getting inflation under control has not been quite as successful, you could say, as the Fed have managed to do. And there's also a huge divergence within the economies. So we think about the EU as one geographic zone. But in fact, if you look at the economic performance of Germany, for example, in recession, very industrial economy, not doing well, versus like Spain and Ireland, who are showing decent growth. So it's hard to make a uniform statement across the board, and certainly a lot of divergence between the individual country performance.
How difficult are higher commodity prices? Last year we were really worried about Germany and continental Europe. As gas prices rose up, they managed to avoid taking a huge hit from that by storing enough. But is it still a concern?
Definitely. And I think it's a real concern right down to the consumer level in terms of perception, because as soon as the headlines start to come through, particularly about the oil price, everyone realizes how much that really impacts what they pay both for energy and also the cost of fuel at the pump here in Europe and the UK, which is much higher than it is in the US. So I think there's a bit of a concern that if consumers start to see that, they will then start to rein in spending as they prepare for perhaps another winter of significantly higher energy costs.
In Germany, I guess there's such a importance of China as a trading partner, and the China reopening has been disappointing relative to, I guess, maybe the beginning of the year expectations. How is Germany and its economy dealing with that?
Well, if you look at the headline numbers of the GDP levels, you could say not very well.
Yeah.
As you implied, Germany is obviously a big export economy and pretty much reliant on a lot of those overseas markets, China just being just one of them. And if we think what happened through the pandemic, where we had supply chain issues, which was then impacting growth. And now we have it on the demand side. So we've gone through a full cycle with none of the upside of the upcycle because you've had a bit of a double whammy on either side of that. There are other things that are specific to the German economy, a whole other topics around the green agenda and the cost for businesses to try and comply with what Germany are trying to do around sort of green and sustainable policies, which is definitely impacting the economy as well.
Is the green transition not going to be a driver of growth down the road? I look at expectations for the German economy, and they're low, obviously. We're looking for a contraction this year and only 0.6% GDP growth next year. But is the green transition going to be a driver there, or is Germany going to be penalized by its reliance on the internal combustion engine industry?
Yeah, I think if we were to look 10 years ahead and then look retrospectively, you might be able to say that the transition to green overall created jobs, created growth. I think the pain comes in the transition period If you look at the number of people who are still employed in industries around fossil fuels, around the automotive industry, as in, fuel-powered cars, not electric cars, it's huge. And you don't just get an automatic replacement of them, you get a displacement which impacts the economy before, call it, the new green economy starts to take off. And I think there are more concerns that the short-term pain of pushing towards sustainable policies, the same in the UK, and our Prime Minister's now starting to rein that in a little because he realises that the transition period will be painful.
By the way, how's Brexit been? Boo. 2016, right? Was that 2016?
I can't believe that.
So
passed.
7 years on, are you just reveling in the benefits of independence? I mean, has it been just an amazing weight lifted from your shoulders, the freedom of doing it on your own, all the incredible trade deals that you've made? I mean, what courage, that took.
Yeah, so I think the idea of Brexit had lots of very positive components. The challenge for the UK government was in the execution plan, and circling through 4 prime ministers in that time to try and execute the plan in the middle of a global pandemic meant that getting those big trade deals done was definitely more of a challenge. And of course,
too much partying, right? They shouldn't have partied so much.
Got to let their hair down. And I think the issue now, just coming into the political cycle, I know it's the same in the US as we come into 2024, that we're starting to see, really big shifts in the sort of left to right movement, or whatever way you want to look at it, in the direction of travel, where, in the UK, the leading party in the polls is making very clear signs about a much closer relationship with the EU again. So just as businesses have got used to the new operating environment, you start to sort of inject more of that uncertainty back in. So we'll see how the politics shape up next year.
Jackie, thanks so much for joining us. I really appreciate it, getting your views. Jackie Bowie, Managing Partner and Head of EMEA at Chatham Financial, based in London. I wonder what a pint costs going to cost me next time I'm in London.
I don't know, but I can't imagine it costs any more than £5 or £6.
Okay, well,
which
maybe
is still a fairly high price for a pint of ale, but at least you're in London drinking a pint.
Yes.
It's worth it.
You picture Tom at a pub when he goes to London?
Yes, I do picture Tom at a pub when he's in London.
Do you recall a time when, this is years ago when I went in college, the bars were not allowed to open during lunchtime? It was like a holdover from World War II when they didn't want the factory workers producing,
I do
planes
not
and
remember
armaments.
that. I lived and worked in London for many years, and I was at the bar every lunchtime.
No surprise there.
Yeah.
Shocked.
That was one of the best things I felt about the whole culture, was the daytime drinking was acceptable.
And they must love you in Spain, too.
Yeah, in Spain, they're just drinking all day.
But then they
Germany,
see
I think most of the civilized world,
Yeah, what's wrong with us here? We're working too hard. We're going to have more coming up. This is Bloomberg. Good morning. Let's get some company news right now with Lisa Mateo.
You got it. Good morning, guys. Costco hasn't given details on when its membership fees could increase, but it did highlight an earnings beat. Bloomberg's Simone Foxman says it was a mixed bag.
Earnings per share beat analyst expectations, coming in at $4.86, but comp sales coming in a little bit weaker than anticipated, especially when you include the impact of currency and gas. Overall, we're looking at 1.1%. The street had been looking for about 1.8%, especially seeing a little bit more weakness in the United States. The company's saying it's seeing those customers trade down. Big ticket items purchases still weak.
Costco right now up about 2%. Now, Costco also said shrink, not a big issue for the company, but it is for another major retailer. Bloomberg's Gina Cervetti has that story.
Target is closing 9 stores in 4 states because of losses from rising retail theft. 1 store in New York City will be shut down, along with 2 in Seattle, 3 in Northern California, and 3 in Portland, Oregon. Separately, the National Retail Federation said U.S. retailers are not only closing stores, but cutting hours and changing product selections because of an increase in crime.
Target right now up about 0.6%. And walkouts are picking back up at CVS Health. Pharmacists in Kansas City, Missouri, are protesting working conditions in its drugstores and other locations. They began the job action last week and met with its chief pharmacy officer yesterday. But sources tell Bloomberg that the company reneged on a promise for a public apology, so they decided to resume the walkouts. The pharmacists aren't part of a union, but it has been discussed. Shares of CVS Health right now, they are down about 1.5%. I'm Lisa Mateo.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, Matt Miller, Paul Sweeney, live here in the Bloomberg Interactive Brokers studio in New York City. Well, we had some green on the screen there at the start of the day, but nope, dipping lower. S&P off 0.1%, 4 points. The Dow off 100 points, so much for that. Let's switch over to the yield space. A little bit of a lift to yields here. The 10-year Treasury's up about almost 2 basis points, 4.55%. I'll tell you where we've got some movement today, and that's in the commodity space. Look at WTI crude oil up 2.9%. I'm going to call it $93 on WTI crude oil. Brent's, I'm going to call that at 96, round up a little bit. So how about that? Oil continues to move.
$96 a barrel.
Exactly.
Unbelievable.
And now when you get your big Dodge Challenger Scat Pack, that's going to cost you a pretty penny to fill that bad boy up.
That's true, but lately I've been looking at 2020 BMW M760 Li with a V12 engine. It gets even worse mileage than the Scat Pack.
There you go. You got that to work on. All right, right now let's head down to Washington, D.C. Amy Morris has got world and national news.
All right, thank you, Paul. The Senate moving forward with that short-term government funding bill to try to avoid a shutdown by the end of this week. Senate Majority Leader Chuck Schumer.
This bipartisan CR is a temporary solution, a bridge towards cooperation and away from extremism.
And Senate Minority Leader Mitch McConnell supports the bill and says a shutdown doesn't strengthen anyone's political position.
They don't work as political bargaining chips. They create unnecessary hardships for millions of Americans.
House conservatives have said that they will move to oust Speaker Kevin McCarthy if he tries to allow the Senate bill to come to a vote. Travis King is in American custody. North Korea has released the U.S. Army private who crossed the border from South Korea 2 months ago. Bloomberg's John Herskovitz is watching that story from Tokyo.
We don't know what happened to him in North Korea or the reason why they're sending him back. They usually use these as bargaining chips, but it hasn't spoken to the U.S. for several years. So it was difficult for North Korea to leverage Travis King.
Bloomberg's John Herskovitz. North Korean state media saying King confessed to crossing the border because he, quote, harbored ill feeling against inhumane maltreatment and racial discrimination in the U.S. Army. The stakes are expected to be higher for the second Republican presidential debate tonight. University of Miami's George Gonzalez says there are 7 candidates, including the front runner, former President Trump, who calls the debates stupid.
Not only does he not need to share the stage with his other candidates, but it would potentially be detrimental to him, his candidacy, if he did share the stage.
The latest Real Clear Politics poll shows Trump is in the lead with 59% support. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Amy Morris, and this is Bloomberg. Paul and Matt.
All right, Amy Morris, thank you so much. We appreciate it. All right, Matt, pot stocks gaining today after the Senate Banking, Housing and Urban Affairs Committee advanced the Safer Banking Act. Now, the Safer Banking Act would allow banks and credit unions to work with the legal cannabis industry. This is big.
Yeah, it is huge. The MJ Pure Play 100 Index, which is a basket of stocks that tracks the industry, was up more than 4%. Some of the big winners on the day: Aurora Cannabis up more than 5%, Verano Holdings up almost 7%, Trulieve Cannabis up 7.7%, Canopy is up 10%, Tilray also, and Green Thumb Industries up about 5%. So there are a number of ways to play this. Individual stocks, as I said, there's an index you can track. There's an ETF, obviously the number of ETFs, but the Advisor Shares Pure U.S. Cannabis ETF is up almost 9% today. So any news that we get, something like marijuana being moved from Schedule 1 to Schedule 3, as has been requested by the White House, the DEA has to act on that, or the Safe Banking Act getting some action, it really spurs these stocks.
Yeah, it does. Any tangible progress from the Senate will be well received, as it represents a regulatory milestone from a chamber that has historically had no momentum with advancing cannabis legislation. Wedbush analysts, including Gerald Pasquarelli, he wrote that in notes. So getting a little bit of movement there on the banking side for legal cannabis. We're going to have more coming up. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, coming up in this hour, we're going to check in with our former colleague, Callie Cox. She's now U.S. investment analyst with eToro. Get her thoughts on this market. Then Odessa Kushi, Deputy Chief Economist at First American. She's going to join us to discuss the housing market going forward. Give them, man, mortgage rates north of 7%. And then our good friend Everett Millman, he's the Chief Markets Analyst at Gainesville Coins. We talk all things commodities, maybe throw in a crypto question in there as well. But first, let's kick things off with Mr. John Tucker.
And Paul and Matt, stocks have now turned pretty much lower in the S&P 500. 7 of the 11 major industry groups are down. best performing group, energy. You mentioned oil, around $93 a barrel. That's West Texas. And as yields rise, yields on the 10-year touching 4.56 on Tuesday. That was the highest since 2007. The 10-year right now, 1 basis point higher, 4.55. So stocks following that move. As they do hover around the multi-year highs, Chris Barone at Stratega Securities, he said earlier the trend is still higher.
You know, most in this business have spent their whole career waiting for bond yields to go up. And now it's finally happened, and all people are clamoring to do is to buy bonds. I think it's too early. The trend in yield is up until the market suggests otherwise, and the market has not suggested otherwise here yet.
Right now, the S&P 500, 2 points lower, 4270 on the index. The Dow Jones Industrial Average now 76 points lower. That's down 0.2%. The NASDAQ 100 down right now just a point. More than 50,000 Las Vegas-based hospitality workers just voting to authorize a strike if negotiations with the city's biggest resorts fail to yield a new contract. It was interesting, some of the comments from Anil Kashkari, the Minneapolis Fed president, saying with the auto strike, with potential for a government shutdown, some of these events, these negative events, could actually do some of the heavy lifting for the Fed. So maybe they won't have to, you know.
True, or they could work the other way, right? They could drive inflation. If they don't produce as many cars, that's less supply where the demand remains the same. And if they raise wages, that's higher pay chasing after the same pool of goods. So
you got to take care of the people in Vegas. I always tip well in Vegas.
I hope they don't strike at the Sphere, because I got to go there.
Yeah, that's going to be cool.
I got to check out Jimmy Dolan's Sphere.
Yeah. See if you can fix the Knicks.
It looks awesome.
It does. It looks very cool. All right, John Tucker, thank you so much. We appreciate it. Matt Miller, Paul Sweeney, live here in our Bloomberg Interactive.
Are you a U2 fan? Because you're Irish.
I'm a big U2 fan.
Yeah.
Sure.
Because they're doing a residency.
I know.
There. They're kicking it off.
I will definitely hit that.
I
have not seen U2.
They're still around. I thought it was funny because Business Week said the Sphere, they wanted to, use this new technology to bring a whole new generation of kids to the entertainment industry in Las Vegas, and then they're going to usher them in with an 80-year-old band. I don't get that. Like, I stopped listening to U2 after Joshua Tree, which was like 1988.
Stop. You're not representative of the true U2 fan. Matt Miller. All right, we're streaming live here on YouTube, so head over to YouTube because we're what the kids are, youtube.com/Bloomberg Radio. Speaking of the young folks, Alex Semenova joins us. She's a Bloomberg equities reporter. She's on the cutting edge of everything. What's going on in these markets, Alex? What are you looking at?
Well, great to join you guys. Happy Wednesday. I'm taking a look at shares of Costco. Brings back some fond memories of my childhood walking through and trying all the samples. Those shares are up about 2% after they reported earnings that beat Wall Street estimates. Sales figures showed that shoppers continued to flock to the warehouse store to buy bulk purchases of groceries. They did scale back, however, on buying the bigger ticket items, which is a sign of a retreat in consumer spending on discretionary items. Inflation still pretty elevated. People are worried about the economy. Their CFO highlighted that customers were making more trips, so store traffic rose about 5% for the year, but overall spending did fall. And a concern that analysts at Morgan Stanley flagged was that Costco didn't mention when they might be hiking membership fees. That's why the initial price reaction to those earnings, the stock was lower. But it's not a sign that they won't be hiking in the coming quarters. Morgan Stanley estimated that an increase in membership prices would boost profits by about 3% in the subsequent 2 years, and they said that that hasn't been baked into analyst expectations yet.
All right.
Are you a Levi or Lee or some other jeans brand?
My favorite jeans brand is Samurai. It's a small brand out of Japan.
I shouldn't
They
have asked.
use
I shouldn't
the
have
old
asked.
looms from pre-World War II.
Yeah, bad question. Levi Strauss. I'm a Levi jeans person. You're Wrangler, Lee, or Levi. Ignore what Matt was saying. What's Levi Strauss saying?
Yeah, well, that's the reason that Cowen started coverage on the stock is their brand loyalty that you just mentioned, Paul.
Right.
They cited that as a reason to initiate coverage with an outperform rating with a $16 price target. The firm sees positive long-term earnings growth potential for Levi Strauss. They cited a 6% annual revenue growth and consistent gross margin expansion, again, pointing to that brand awareness and market share. As
See, if you can't buy your jeans at a local Army-Navy store, they're just not worth wearing. That's what I'm saying.
Dude, I get you into a pair of Samurais and you will, like 25-ounce denim when you wear these things, you're like armored, right? They should sell these at Army Navy stores.
All right, Alex, thank you so much for joining us. Alex Semenova covers all the markets for Bloomberg News, joining us live here in our Bloomberg Interactive Broker studio. Former colleague of ours, Callie Cox, back in the studio, U.S. investment analyst with eToro. So, Callie, what do you make of this market? I mean, there's people, last 4 or 5 weeks, people have gotten very nervous here about this whole interest rate environment and what it may mean, how do risk assets perform in a higher for longer environment, but does that really bring back onto the table recession? How do you guys think about that right here?
Yeah, well, we see people building a wall of worry, and we think that's a good thing. And I'm not trying to be overly optimistic here, but if you think about this list of worries that we're going through, student loan payments restarting, if you think about higher oil, higher yields, potential government shutdown, there's a reason why people are nervous, but put them all together, and I could only count a few of those as actual systemic risks to the economy. So that's what we're telling customers. Keep an eye on oil, keep an eye on yields, even though yields are telling us a good thing, still pressure on the economy and markets, but everything else might just be a distraction.
All right, so I'm sorry, but you sound still pretty constructive on these markets here?
We're I hate this phrase, but cautiously optimistic.
Okay.
We're constructive, but we're also asking people to really tread carefully and pick up quality risk. Don't go all out here. I mean, we are in a bull market until proven otherwise, until we see that recession or that crisis. Right now, there are a few signs of that, but at the same time, we don't know what cracks could be forming underneath the surface.
So how worried are you about, the government shutdown, which is very likely to come this weekend, the strikes, the UAW strikes being prolonged? I mean, is this a factor in your analysis?
Yeah, so we think about the strikes and the shutdown a bit differently, even though the shutdown is kind of like a forced strike from government employees, right? So the UAW strike, of course, is front and center of our minds, especially because we have a lot of investors who own auto stocks, and this is a big deal for the auto industry. I mean, luckily, we're talking about U.S. production here, and U.S. production is just a small share of global car production. I mean, U.S. consumers use a lot of cars, but they don't exactly produce a lot of them. So we think global production could fill the gap there, but at the same time, I mean, this is another worry to lop on top of an economy that's under a lot of pressure. Government shutdown, again, I mean, if you look historically, they haven't made much of a dent in either the economy or markets. It's usually just a distraction. But going back to systemic risk, I mean, we don't know what's happening underneath the surface, and we're encouraging people to not freak out too much, but understand that this is just another piece of pressure that investors have to think about.
Well, why don't I just sit with my 2-year Treasury at 5.1%? That's pretty good.
I mean, a lot of people are doing that. I mean,
so
look
is
at
that something you
money
guys?
market
I mean, is
funds.
that something you guys are seeing from your clients or hearing from your clients, and what are you telling them about that?
Oh yeah, we hear it all the time. We did a webinar with clients yesterday, and that was one of the first questions that came up. And it's a very fair question. I mean, that's the 5% is the most you've been able to get on money in 30 years. So we frame it like this. I mean, time frames matter a lot when it comes to considering whether to go into cash or go into equities, or basically when you're determining how much risk you're taking on here. Because cash at 5% is great for short-term goals, but remember that yields are probably not going to go much higher from here. The economy is probably going to slow down from this 5% annualized pace people think we're growing at in the third quarter. And if that's the case, if the Fed starts cutting rates into next year, that's the rate that you're getting paid on your cash and, on your bonds, unless you, of course, hold them to maturity. So, we have a lot of longer term investors on the platform.
Well, if you get 5%, on a 20-year, you're getting that for the next 2 decades, plus the appreciation. If yields go down, your capital is then worth more.
Yeah, and it's tempting, but you also have to remember the S&P has a 7% average annual return, and that compounds as well over the years. So, with younger investors, with a lot of millennials and Gen Zs on the platform, we tell them to think about the fact that they have time on their side. So cash is good, but you really have to think in the gray areas when it comes
Who
to
is a
portfolios.
typical eToro client, customer?
So we skew toward the older millennials and the Gen X's. But we do have a younger investor base when compared to other traditional platforms.
Did they invest differently? Did they think differently? Or is it just simply, hey, you guys are young, you need to think longer term, and over the long term, stocks outperform most other asset classes? Is that kind of the basic message?
Well, they're a little more complicated than that. A lot of our customers are those long-term investors, but they have that active account on the side. They're interested in crypto. They're interested in investing with the community.
Because we never talk about crypto anymore. It seems like it was almost every day, and I used to quote it all the time, but now we don't talk about it.
Why bother? It's just 26,000 without looking. Let me see. I haven't looked today, but
You're probably pretty close.
And I mean,
26.
I think it's more interesting to talk about investing with the community. So what exactly does that mean? Somebody has a model portfolio, you might like it, and you can then clone that portfolio, like tracking an index?
Yes, so we offer that for crypto, Matt. We call that not our smart portfolios, but being able to follow somebody and being able to invest if you like the crypto that they're investing in. I mean, that's what we're trying to promote here. We're trying to promote the transition of ideas, the ability to talk about what you're investing in and the ability to see what other people are investing in as a track record type thing. These are my returns. This is what I have in my portfolio. If you see yourself as a similar investor, then maybe.
But is it only for crypto? I mean, can I not, like, if Paul goes on there, can he put his munis and all of that sort of baby boomer stuff on there, and I can say I want a boomer account, so I just clone his account and do the same thing?
Not in the U.S. yet, but we're hopefully working toward that. And Paul, if we get there, I would love to create a baby boomer portfolio just for you.
There we go. See,
he's the tail end. He's the last. He's the last month of baby boomers.
Still counts.
Literally, December 63. John Tucker, he's more firmly ensconced within the. No?
Kelly, you're closer. Would you reach over and just smack him?
All right, so
I don't know if I can do that.
Kelly, what's kind of the big issues that are coming up from your clients? You had the webinar. What are they worried about? What are they excited about? Your clients.
Yeah, well, they're worried about a recession, but the funny thing is they feel really good about their financial situations right now. They say, I don't have a reason to really change up my portfolio, but I'm frozen. I'm not quite sure what to do here, especially because things just don't feel good around me. So we're encouraging them to, again, focus on their whys, understand what their different accounts are for. If they want to be active, there are plenty of opportunities in this environment. You just have to be careful. And on the long-term side, I mean, we're quite optimistic on the U.S. economy over 10, 20 years. Everybody is, but when you look over the next year, you might have some chances to jump back into a stronger market.
Are ETFs? I mean, do you guys even recommend mutual funds or talk about mutual funds, or is it just ETFs now?
So we have ETFs on our platform, and we're actually noticing that ETFs as a share of volume is growing. Investors are looking toward diversifying their portfolios. Or looking toward broader market and sector trends. So that's a trend that we're watching closely. I feel like everybody is, but it's something that the average investor is picking up on.
I can't even imagine the future of the mutual fund business. I mean, unless it's in a retirement account, why wouldn't you just ordinarily?
Well, but we haven't seen the continuation, not at last year's pace, of conversions to ETFs.
Right.
Which I don't know why that slowed down. In fact, that's a really good
conversion
question.
of a mutual fund into an ETF.
Yeah, last year that was huge, right? And the beginning of this year as well. It's kind of slowed down a bit, but I can't imagine why you would want a mutual fund rather than an ETF, other than, you're not allowed to have ETFs in certain investment cases, so you have to use mutual funds for that.
Yeah, that's the only case I can think of too. I mean, as an investor myself, I have no reason to use mutual funds.
All right, Matt. Yesterday was the beginning of basketball preseason practice. So my question to Callie, being a proud alum of that trade school in Chapel Hill, North Carolina.
Without knowing it, I knew it. She's a Tar Heel.
It's always basketball season when you're talking to a Duke fan.
Yes. Right. So what's the outlook for Chapel Hill this year?
Oh, man. Well, we've had a lot of turnover on our roster. We have Baycott. He's a big guy. He's really good. But quite honestly, I mean, the turnover we've seen, I think it's going to be really hard to tell.
Historically in these conversations, though, Callie, don't you say, hey, guess what? Jordan didn't play at Duke, right?
I mean, that's the thing we can hang over your head forever, right?
What we always say, the only person that can guard or keep Michael Jordan down is Dean Smith, the coach. He's the only one that could keep Jordan from doing amazing things, Dean Smith, by limiting, the type of playing that he could do.
But Jordan did amazing things. He's the greatest of all time.
Of all time, and he got that in the pros. But anyway, so it'll be interesting because what's the feeling about your coach? Hubert.
Oh, I love Hubert.
Now-
He's part of the family.
Now, but does that still hold within the alumni base? And is he still really well supported?
I think so. He's on thinner ice than he was, of course, last year, and he's done a really good job recruiting. But it's putting different pieces together on a team that's not used to playing like the 3-ball, basically.
Yep.
We're very big into getting into the middle and grinding in on right below the basket.
All right,
so.
and then Chapel Hill also has a good football team this year.
We do. I would love to talk about football here
Yeah.
because apparently Duke is good.
Very good. Now
That
we
doesn't happen a lot.
It doesn't happen almost any time. They beat Clemson this year at Duke. The last time they beat Clemson was when I was a first-year business school student in 1989. Beat Clemson. I was at that game. It was pouring rain. I was the only one from my study section because we had a big exam on that Monday. Everybody else was doing the smart thing and studying for the exam. I was out in the pouring rain watching Duke beat Clemson, John. So that's kind of how I put my priorities in business. It was a long road to dig out of that hole I started myself in, but
It was worth it.
Yeah, exactly. I passed. It's all good.
It's a historic moment.
It is. So it's all good. Kelly Cox, thanks so much for joining us. Kelly Cox, U.S. investment analyst for eToro and a proud graduate of the University of North Carolina at Chapel Hill.
We should go down there. I would love to. I've never been to UNC or to Duke.
Oh, we'll go down
and
there.
I'd
yeah.
like to just go to each place, party for a couple days.
Yep, we can do that.
With the seniors, and then figure out which one really is the better school.
Well, they're both great, and which is good. And we're only like
I'm
10
sure they're
miles
both fine academically, and in sports, one's always going to be better than the other, but that will change. The real question is, what are the keggers like?
The keggers like? Yeah, I don't know. They're pretty good at Chapel Hill. Better UNC, says Callie. And she would know. She was there much more recently than I was. But it's in 10 miles apart, 15,501, having those two schools so
Do you
close
not just
together.
go back and forth?
Well, we used to
is
go-
there a bus? Is there a...
People do.
Some
There
people do.
are buses too.
Yeah.
Yep.
Yeah, so some you used to have to go there to have fun at Chapel Hill. Now Durham is the hot town, and everybody's kind of coming to Durham. Great restaurants, and yeah, it's good stuff. This is Bloomberg. Let's get some company news with Lisa Mateo.
I'm getting the feeling you guys were frat boys. I don't know why I'm getting that. Good morning. Rivian is fluctuating after Baird named the electric vehicle maker a, quote, bullish fresh pick, saying third quarter deliveries will probably top expectations. Bloomberg's Ed Ludlow points at the company's guidance.
The question, I guess, is how much further above guidance they're going to go. This is an EV name, pure play, that is kind of not in the same category as the other startups that have struggled. But remember that they have a plant in Illinois that is capable of building 3 times what their current guidance is.
Shares right now, they're down about 0.5%. And first it was issues with thefts, now a recall for Kia and Hyundai, covering more than 3 million vehicles. Bloomberg's Gina Cervetti has the details.
There are two separate issues, but both involve the brakes and both risk sparking an engine fire. Kia's action involves model years 2010 up to 2019 and includes the Cadenza, Forte, and Sportage, among others. Hyundai's action covers model years 2011 through 2015 and includes the Elantra, Genesis, and Santa Fe. Federal safety regulators advise owners to park their vehicles away from any buildings until repairs are completed.
Hyundai shares right now up about 0.2%. And Mitsubishi Motors will end production in China. That's according to a report from Nikkei, which says the Japanese automaker is making final arrangements with its Chinese venture partner to stop manufacturing. Now, the news comes 2 months after Mitsubishi suspended its business in the country following years of poor sales. A spokesperson tells Bloomberg News that the company is discussing future plans with shareholders, but nothing is finalized. Mitsubishi right now is in the red. I'm Lisa Mateo. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. The Dow Jones Industrial Average, let's start there, declining, resuming the decline from yesterday after falling below its 200-day moving average. So that's a technical indicator that does suggest the index may be oversold at this point. Traders waiting for speeches from Fed Chair Jerome Powell and a bunch of other central bank officials later this week. But Treasury yields, they've been in the driver's seat lately, edging higher once again, approaching around the 16-year highs. We have the S&P 500 right now 2 points lower, 42.71. Again, the Dow 68 points lower. That's down 0.2%. The Nasdaq 100 up just 9 points right now. Some of the individual shares we're taking a look at. CVS Health facing a resumption of walkouts this week by pharmacists in Kansas City, Missouri. They're protesting working conditions in the drugstores and other locations. Shares right now down 1.7%. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash. The CVS pharmacists in my town, they now take a lunch break, so you can't get...
From 1:30 to 2:30.
Dude, don't get me started on CVS pharmacists.
Oh, go easy.
Well, they're
easy.
overworked.
They're overworked. That's totally true because now everybody's on multiple drugs, as opposed to a generation or two ago. So there's just so much more demand, and there's still just that one person back there.
You're one guy or one woman,
it's true.
and just
the
like...
CVS pharmacy out by me in Scarsdale, there's always a line of at least 10 people, no matter what time I go. And even though I've been sent a text message that says, your drugs are in, come pick them up, every time I get to the front of the counter, they say, come back in an hour. Every time.
Can't you just get it through mail order? I mean, isn't that easier?
I don't know. That's actually a good point.
Yeah, we'll check it out.
Maybe I could.
All right, so that's our little rant on our local pharmacy. I'll tell you what's another
Not to
issue
mention the
here,
fact that everything's locked up and you got a ding, ding, ding. Come over and get this toothbrush
well, that's a
for
whole
me.
other matter.
Yeah.
Bankrate.com, 30-year U.S. Fixed rate mortgage, 7.78%. I'm not going to complain about my 6% mortgage anymore. Ouch. And you've got the 3 something.
Yeah, well, 3 1/4.
Yeah, there you go. So, I mean, how can... I know if you look back like a gajillion years, that's pretty much in line with the average, but still, that hurts. But let's talk to somebody who does this stuff every day. Odetta Kushi, Deputy Chief Economist at First American. Odetta, what's your 30,000-foot view of this residential real estate market? I mean, nobody wants to get out of their house. Nobody wants to sell. If I want to buy, I got to pay this huge mortgage. It's kind of tough out there, isn't it?
It is very tough out there, a lot of headwinds in the housing market, but it's resulted in some really interesting dynamics. The first of which is that we're seeing a reacceleration in house price growth. You know, you've got demand still surpassing supply, and that's Econ 101, right, for house price growth. And so we saw the S&P Case-Shiller reaccelerate. We've seen it up on a year-over-year basis after declining for 3 months in a row. So, and that's pretty broad-based across most markets, of course, with some regional differences. And the other dynamic here is because there are so few existing homes on the market, because of that rate lock-in effect that you alluded to, you know, people are going to the new home market because builders are offering incentives, they're buying down rates, and so the new home market has actually fared better than the existing home market this year.
So what does that mean for affordability? I mean, prices are up, rates are up. Is this a market that is just, deadly for first-time buyers?
It's really tough out there for first-time buyers. As you mentioned, affordability is a function of home prices, interest rates, and incomes. And home prices are up again. Interest rates are moving higher. Incomes are increasing, but it's not enough to offset the impact of higher rates and prices. So it's tough out there as a first-time home buyer, but we are seeing them look to the new home market because, again, with rates at 7%, builders are buying down rates to 6%, sometimes even 5%, and oftentimes also cutting prices on homes. And so the new home market is actually more affordable than the existing home market, which is not traditionally the case.
How are builders able to do that? I've been hearing this too, and I find it fascinating. And how long will they be able to keep that up?
I think it'll be tough. I mean, we saw the new home sales number come down in August. Rates at 7%, over 7%, really biting into affordability and cutting down demand. And builders have had the margins to be able to buy down the rates, but the higher that mortgage rates go, the more difficult that will be.
Odette, I'm just again on that bank rate, 30-year mortgage, 7.7%. That's the highest since 2000. Just extraordinary. So I guess the question is there a rate out there that you think is a clearing rate, for lack of a better word, where it might kind of loosen things up and buyers will be willing to take that mortgage, sellers
What will bring
willing?
about the great reset, as a lot of people have called it, the expected event?
Well, more than 90% of existing homeowners are locked into rates below 6%. So I think certainly if we could start approaching 6%, we'll start to see a lot of activity. There's a lot of buyers on the sidelines. There's a whole generation of millennials that are out there looking for that first home and, on the sidelines waiting for that mortgage math to work for them. So I think if we can start to get rates heading lower, approaching that 6%, certainly that would bring some folks off the sidelines.
What about adjustable rate mortgages? How popular have they become?
We start to see adjustable rate mortgages, the use of those increase as rates increase. So we've seen them come up a little bit over the last year as mortgage rates have increased, but they're still a smaller share of the market.
If I want to go get a mortgage, can I even get one here? And how is the mortgage origination market?
Mortgage standards have been tight, right? So not even just this year, but generally speaking, and certainly compared to the early and mid 2000s, lending standards have been significantly tighter, and so it's probably tougher out there to get a mortgage. Certainly tougher to get a jumbo mortgage if that's what you're in the market for, and so that's sort of another headwind to the housing market.
What's the regional factor here? I mean, it just seems like we just heard so many stories during the pandemic of everybody, going to the Sun Belt, going to Texas, Florida, Tennessee, for crying out loud. I mean, is it? I don't even know where they're putting those people, but are those markets appreciably stronger? Are we seeing more activity there than maybe other parts of the country?
That's right. In the latest S&P Case-Shiller report, the markets that experienced the strongest growth were in the Rust Belt, and then you also had New York. So it was really the Midwest, the Northeast that are outperforming, and then the West Coast, traditionally more expensive markets that really have experienced the strongest price declines. So you've got your San Jose, San Francisco, have had a tougher go in a rising mortgage rate environment.
So I imagine workers there are still in strong demand, construction workers. Are builders able to get everything they need, land, permits, labor?
It's still tough. The supply chain headwinds, the supply side headwinds for builders, some have eased. Some of the material supply side challenges have eased, but there is still a chronic shortage of skilled construction workers. And so, the construction industry is still contending with some of these headwinds.
So do you guys at your shop, do you have a view on mortgage rates, kind of where you think they're going to be 6 months from now, 12 months from now?
Mortgage rates are notoriously difficult to forecast because they're tied to, the 10-year Treasury, which can be influenced by everything from, geopolitical tensions to recession to, of course, inflation. But I will say that the Fed has maintained its hawkish stance. They've made it very clear that they intend to keep rates higher for longer, and that means continued upward pressure on mortgage rates. I'm certainly not seeing mortgage rates, getting back to, I think one of you said you have a 3% mortgage. I'm not seeing that happen anytime soon.
Thank goodness. That was me. So if you have, I guess, slower household formation because affordability is off the charts, does that also mean consumers are spending less money, at, I don't know where people go these days, restoration hardware, Crate and Barrel, furnishing places, putting things together?
I mean, there is a multiplier effect on the economy, certainly from demand sort of subsiding for housing, and of course, if construction slows further, that will have a multiplier effect on, durable goods, housing services. So certainly reduced demand for housing due to the affordability environment can impact demand for furnishings and all of those.
All right, Odetta, thanks so much for joining us. Odetta Cushy, Deputy Chief Economist for First American. Do you put stuff together? Like, can you put furniture together and stuff like that?
So
I know John Tucker does that.
No, he builds furniture,
Right, he
with a
cuts down a
saw
tree
and
right.
trees.
Right.
I just put stuff together that my wife gets from any of these.
But you were in the market for a nice table saw with which to
Yes, and
construct.
I still am. What did you say? Safety saw?
No, there's a
You
saw.
had a recommendation.
A saw stop, it's called. They're
Saw
very
stop,
expensive.
exactly.
If you put your finger on the blade, it'll automatically stop.
Right, it recognizes the
It's a great
conductivity.
safety feature, but it also is a very good, precise contractor saw as well.
Yeah, so I need to spruce up the pool
I'll set
house
you
a
up.
little bit.
Yeah. See, I used to have people for that. I don't have people for that.
Well,
anymore.
people are just so expensive.
Would you trust Matt with a power tool around your home?
No, exactly not. I mean,
All right.
but again,
Just asking.
I used to have people for that stuff. I don't have them anymore, so I have to get a little bit. I think I'm the people now. So, but
That's why I want the saw stop.
Yeah,
because I think I'm the people too.
All right, you get your horse hair coat or whatever it is, and get out there and spruce up the pool house, right, John?
It's horse hide.
Horse hide. Hide. All right, we're gonna have more coming. But actually, right now, let's go down to Washington D.C. Let's get serious. We got Amy Morris. She's got world and national news.
All right, thank you, Paul. The U.S. is on track for an October 1st government shutdown, which would have a cascading economic effect as millions of workers would be going without salary and private contractors won't be paid. We talked with Terry Haynes at Pangea Policy, who tells Bloomberg he is not expecting any concrete resolutions until at least Christmas.
That's when the defense legislation, both the authorization of spending and the spending itself are finished. That gives the Congress time to catch up on other appropriations bills. They need to take that long because they haven't done any work on these things since May.
Terry Haynes with Pangea Policy. Senate leaders, meanwhile, have an agreement on a short-term funding measure to help avoid a shutdown. The bill doesn't have much chance of passing the House, though. That's where Republican Congressman Bob Good of Virginia says a shutdown wouldn't be all that bad.
I've said, hey, we shouldn't fear a shutdown in the sense that we're so afraid of a shutdown that we betray the American people by failing to meet the moment and to cut our spending.
Republican Congressman Bob Good, House conservatives have said they'll move to oust Speaker Kevin McCarthy if he allows the Senate bill to come to a vote. Plenty to watch for tonight from the candidates vying for the Republican presidential nomination. 7 of them will be at the Ronald Reagan Presidential Library for a second debate ahead of the primary as Donald Trump delivers a primetime speech from Michigan on the 13th day of the auto workers' strike. Bloomberg's Kaylee Lyons tells us that's not all.
Asa Hutchinson, the former Arkansas governor who did not qualify for the second debate, is going to be counter-programming Trump's counter-programming. He's also going to be in Detroit this evening holding a press conference, and what his campaign says is he's going to be highlighting Trump's false promises to blue-collar and union workers in Michigan and across America. So there's going to be a lot of split screens this evening.
A lot going on. That's Bloomberg's Kaylee Lyons. We bring you global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Amy Morris, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom, and this Bloomberg Business Flash. Right now, the major averages, major stock averages, they are mixed. Treasury yields in the driver's seat again today, hovering around those 16-year highs, weighing on the risk assets again after yesterday's 1.5% sell-off for the S&P 500 and the NASDAQ 100. Well, as stocks fluctuate, Octavio Morenzi at Optimus advises investors look at short-dated treasuries.
The returns that we're seeing on up to 6-month treasuries are now above 5%. That's really fantastic. You're basically getting 5% for doing absolutely nothing and taking absolutely no risk. So that's the end of the yield curve that I would want to be on, not way out on 10 years and 15 years and 30 years where it looks really risky.
Right now, the S&P 500, 3 points lower. That's down 0.1% right now. Dow Jones Industrial Average, 95 points lower. The NASDAQ 100 up just 4 points. A 10-year Treasury yield, 2 basis points higher. That's at 4.56. The 2 up 3 basis points now. That's at 5.09%. And looking at crude oil, NYMEX crude, that is $3.05 higher, 93.44. Again, West Texas. Oil rising as we had some figures from the EAI. Crude stockpiles, the largest U.S. storage hub, dropped to the lowest since July of 2022. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Matt and Paul.
All right, John Tucker, thank you so much. We appreciate that. Matt Miller, Paul Sweeney, live here in our Bloomberg Interactive Brokers studio. GLCO Go, the global commodity prices. That's the function for that. I look at the metals here. Year to date, pretty much everything is down on a year-to-date basis. A couple exceptions, most notable being gold. That's up 3%. Let's see what's happening in the world of metals right now. When we talk commodities, we talk crypto. We talk to Everett Millen. He's a chief markets analyst at Gainesville Coins. So, Everett, what is happening with gold here? What's the call? It seems to be bucking the trend where I've got aluminum down, copper down, gold down, on silver down on a year-to-date basis, but I've got gold higher.
Yeah, thanks for having me on. I think it's really interesting that gold has been fairly resilient, hanging out around that 1900 mark, even with so many headwinds working against it. You have the dollar climbing to its highest in 6 months, rates being higher, real rates being higher is usually negative for gold. And we've also just come out of the summer months, which are typically, they see poor seasonality for the gold market. And in spite of all that, you're right, gold has held up relatively well. And I think a lot of it has to do with the fact that central banks continue to purchase gold and kind of place a floor beneath the price. And in many cases, sure, this is done to stave off currency depreciation, but it's also a sign that central banks are probably hedging against the potential for a policy error or an economic downturn in the near future.
So which central banks had the most gold and who's doing the buying?
So as of now, the Federal Reserve still holds the most gold in the world, but the big buyers we see are mostly in the East, especially as we've seen outflows from gold ETFs in North America and Europe. Typically, most of that gold ends up flowing into China and India. And so the People's Bank of China is certainly continuing to buy gold. And what's interesting is there's been this persistent premium on gold in Shanghai relative to London. Now, there is some speculation that that's perhaps due to policies followed by the PBOC, but really what it says to me is it's just a sign of robust demand for gold in China. And that's important because China is always the #1 consumer of gold in the world.
By the way, how do you play that arbitrage? I mean, it's not like you're going to load up, a plane full of gold bars in Shanghai and fly them into Heathrow, right? Is there any way to play the difference?
Well, that's a great question. There's been some suggestions that perhaps that could be done through Hong Kong, given that it is still under Chinese rule, but is somewhat of a separate, special financial zone. I don't think that there's any practical way to play that arbitrage. But again, outside of the East, sentiment in the precious metals market is still rather pessimistic. So even if there was a way to play that, I don't think a lot of investors are really tuned into that or paying attention to that.
Everett, how closely do you watch the dollar. I mean, I always have the Bloomberg Dollar Index on my screen. A lot of people watch just DXY. But right now we're trading at 1270. It's the highest level we've seen in about a year, showing some real strength against our trading partners, but also obviously strength in gold terms, strength in oil terms, et cetera.
Right. It's always important to watch the dollar. The fact that it has strengthened so much against its peer currencies around the world shows up in the gold price, especially this week. We've seen gold drifting lower. But when you look outside of the US, in most other currencies, gold is at or near all-time highs. So it sort of is just a relative comparison that the strength of the dollar in the West, it tends to dampen interest in gold. But there's not always a direct line. So about a year ago, we saw the last time that the DXY was at these levels, we saw that both the dollar and gold rallied in tandem. And sometimes when there are safe haven concerns, you can see that kind of paradoxical relationship happen.
Paul and I were just talking about how boring it's been to quote Bitcoin lately. It's just holding at 26,000. But actually, when you look at the strength in the dollar, it's pretty interesting that Bitcoin's been able to hold this level.
That's right. It has been somewhat range bound. And I think clearly we're going to have to get some more clarity on the regulatory end. We still have not gotten a Bitcoin ETF approval. And to kind of make a comparison to gold, the gold market about a decade or two ago experienced much greater liquidity and much greater demand once a gold ETF was launched. So I believe a lot of Bitcoiners are looking at that experience and hoping if there is a Bitcoin ETF, it's going to ease access for kind of lowering that barrier of entry for people to get invested into Bitcoin. And it's also important to keep in mind that anyone who has been in the crypto market for a few years, they've experienced these kind of crypto winters before. So the current poor sentiment regarding cryptos and Bitcoin is not necessarily the death warrant that I think some perceive it to be.
So what is the future of this ETF here? I mean, it's kind of, it feels like the crypto space, Matt and I were just talking about it, it's no longer top of mind or it's on what everybody wants to talk about as much as it was, say, 6, 9, 12 months ago. And I'm wondering, is the space just waiting on how this ETF issue will be resolved?
I think so. And along the same lines, you know, you have this tug of war between the greater trust and legitimacy that would come with an ETF and greater regulation. But on the other hand, pulling in the opposite direction is the fact that the crypto market has always been characterized by this kind of freewheeling behavior where it thrives without any oversight. And I think one of the important things that, as you point out, that the market seems to be waiting for is there's an IRS proposal for new tax reporting rules on digital assets. And so far, that has not been very well received by the crypto industry. And we already know with the FTX debacle what a complete lack of regulation and oversight looks like. But we're going to have to get some kind of clarity in that realm. Otherwise, you will see all of the activity in DeFi, in Web3, in the crypto space will almost certainly move offshore and leave the US.
All right, so Run, well, quick question, 30 seconds. Silver, what's the call here?
Silver is one of those interesting, disappointing things for the precious metal bulls. It has not really performed the way that they expected. At the same time, we have to keep in mind that year on year, silver's up about 23%. And I'm looking at a lot of supply concerns. Mexico has seen its silver output drop by nearly 20%. They're the world's largest producer. So supply concerns, I think, give silver some fuel to move higher in the short run.
All right, Everett, thank you so much. We appreciate that as always. Everett Millman joining us, Chief Markets Analyst at Gainesville Coins. Bitcoin, it just feels like it's kind of really range bound here.
True, but I just think, I mean, if you look at BBDXY index and just graph it, I don't know, year to date, right? You can see that we've really taken off from the lows which we hit in midsummer, but also at the beginning of the year. I mean, we were down at 1213 at the beginning of February, and right now we're at 1270. So considering this chart and the strength of the dollar, I think Bitcoin holding at $26,000 isn't as disappointing as it may seem.
Very good. We always keep an eye on Bitcoin. Tom Keene, with maybe perhaps
he quotes it more often than me, and yet he makes fun of me for quoting it.
Let's get some company news right now with Lisa Mateo.
Good morning. The last remaining co-founder of Peloton is leaving the company. Chief Product Officer Tom Cortese is passing the baton on to technology industry veteran Nick Caldwell. Cortese will remain an advisor to the fitness company after stepping down on November 1st. Shares of Peloton right now up just a fraction. And shares of UBS, they are falling. They're down about 3% after a report from Bloomberg that the Justice Department is stepping up its probe into the Swiss bank and Credit Suisse. Now, it's reportedly over suspected compliance failures that allowed Russians to evade sanctions. Bloomberg's Hugo Miller explains.
This is more a case that fundamental compliance failures, when you onboard, to use the bank jargon, a client, or when you offboard a client, you have to make sure that you're doing the necessary compliance. And in this case, as we've seen in a number of other cases with Credit Suisse, in this case, what the DOJ suspects is that there were just some fundamental failures of due diligence that allowed the bank, primarily Credit Suisse, to continue to provide banking services for sanctioned Russians.
Now, Miller also says that the probe is at an early stage and might not lead to charges or even a settlement. U.S. auto retailer AutoNation has offered to buy one of the UK's largest car dealerships, Pendragon. Now, the Financial Times says AutoNation's bid values Pendragon at more than $500 million US. Pendragon said it was, quote, carefully considering the proposal. Now, two other companies, they're also looking to buy the dealership, so there could be a bidding war brewing. Right now, shares of AutoNation, they are up about 2%. Those are the company stories we're following this hour. We'll have more Bloomberg Markets in just a bit. I'm Lisa Mateo. This is...
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, Matt Miller and Paul Sweeney live here in our Bloomberg Interactive Broker studio, streaming live on YouTube as well. S&P 500 off 0.2%. NASDAQ off 0.1%. So feels range bound here today at least. Yields moving higher. 2-year Treasury 5.11% on your 2-year. Going out 10 years gets you 4.58%. That's up 5 basis points today. Still inverted, but less so. And of course, WTI crude oil up 3.4%. That's $3.04. $93.42 a barrel on WTI crude. We continue to follow that closely. Right now, let's head down to Washington, D.C., because Amy Morris has got World and National News for us.
All right, thank you, Paul. Senator Robert Menendez of New Jersey pleaded not guilty to corruption charges as demands for his resignation intensify. Bloomberg's Nathan Hager has details from Washington.
The Senate's number 2 Democrat, Dick Durbin, is now calling on Menendez to resign. In a post on X, formerly Twitter, the Illinois senator said leaders in New Jersey have made clear Menendez can no longer serve. This is a shift for Durbin. Over the weekend, he told CNN's State of the Union Menendez should be presumed innocent and voters should decide his fate. Senate Democratic leader Chuck Schumer has said little beyond a statement last week that Menendez deserves due process in the courts. In Washington, I'm Nathan Hager, Bloomberg Radio.
Travis King is in American custody. North Korea released the U.S. Army private who crossed the border from South Korea 2 months ago. Bloomberg's John Herskovitz is following that story from Tokyo.
We don't know what happened to him in North Korea or the reason why they're sending him back. They usually use these as bargaining chips, but it hasn't spoken to the U.S. for several years. So it was difficult for North Korea to leverage Travis King.
Bloomberg's John Herskovitz. North Korean state media says that King confessed to crossing the border because he, quote, harbored ill feeling against inhumane maltreatment and racial discrimination within the U.S. Army. One of the strikes in Hollywood has come to an end. The Screenwriters Union approved a new contract with studios, so writers return to work today. Bloomberg's Abigail Doolittle.
They got the 3 big demands that they wanted. First, they got a pay boost. They also have a piece of the action for some of the streaming shows that do especially well. Second, shows will have appropriate staffing level. And third, they've received a reassurance that AI will not be replacing their jobs.
Bloomberg's Abigail Doolittle. Hollywood actors are still on strike. No talk scheduled. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Amy Morris, and this is Bloomberg. Matt and Paul.
All right. Thank you very much, Amy Morris. We appreciate that. What is this story you've got here, Matt? Katy Perry.
It's an amazing story.
Katy Perry and 1-800-Flowers founder spar over $15 million home.
Yes, well, I mean, that's what she agreed to pay for it. He just bought it for 11 and change in May of 2020.
Oh, so during the pandemic.
So we're talking about Carl Westcott. He is the founder of 1-800-Flowers, former private equity manager. He says that when he signed the agreement to sell the home to Katy Perry, and I guess her partner Orlando Bloom, he was on painkillers.
Oh.
He was all jacked up on painkillers. And so he made
Not
the wrong
sound
decision.
mind and body, I guess.
Exactly. So according to Bloomberg reporting, he bought it for $11.25 million in May of 2020. And then in July, he signed a contract to sell it to Katy Perry's business manager for $15 million. That's a quick profit,
That's a quick
right?
profit.
For like 3 months?
Right, but I guess he's in declining health, and his son says he wanted to die in the house. Westcott's son, Chart Westcott, said in an interview. So
his son, unless this is a typo, his son is named Chart.
C-H-A-R-T, right. And apparently they are going, like the Chartress, as we know. But apparently they're going to court on this thing.
Yeah.
Isn't a contract a contract? I mean, I don't know.
I guess if you're all hopped up on meds after a major surgery, you're in no condition to enter into a contract.
I presume
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
We got a lot of green on the screen here, but the volume is light.
We constantly underestimate the strength of the U.S. consumer.
This is a market that's much more optimistic or bullish than maybe the central bankers are.
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
The supply chain has still got dislocations globally and here in the U.S.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, coming up in this hour, we're going to do a deep dive on the bond market, and who better to do that with than Jerry Kudzil. He's a General's Portfolio Manager at TCW. That's Trust Company of the West, folks. They have a lot of assets under management. Then we're going to check in with Brett Ewing, Chief Market Strategist at First Franklin Financial, get his thoughts on this marketplace. Is there a constructive call on this market right now? Then Eileen Mullaney, she's Workforce Transformation Lead at Vialtro Partners, discussing this whole back to work, hybrid. Where are we in that whole situation here? We'll get the latest there. All I know is Matt and I are in the office every day, as is our good friend Charlie Pellet.
On, we do have the Dow, the S&P, NASDAQ all very much in the red. Stocks are wavering as a sell-off in treasuries resumes, with investors contemplating the prospect of higher rates and a looming government shutdown. Here's where we stand. The S&P 500 index, which had been up 18 points, is now lower by 12 at 4261, down by about 0.3%. We've got the Dow Jones Industrial Average down 151 points, a drop there of 0.5%, while NASDAQ is down 29, a decline of 0.2%. 10-year yield 4.57% with that 2-year right now 5.10%. Spot gold down $20 the ounce to $18.80, a decline of 1.1%. And West Texas Intermediate crude now at 93.76 a barrel. WTI up another 3.7%. So what is on the minds of investors? Callie Cox is investment analyst at eToro USA Securities, and she was a guest right here on Bloomberg Markets.
Well, they're worried about a recession, but the funny thing is they feel really good about their financial situations right now. They say, I don't have a reason to really change up my portfolio, but I'm frozen. You know, I'm not quite sure what to do here, especially because things just don't feel good around me.
And you can hear more of that conversation on the Tape podcast. You can download it wherever you get your podcasts. Oil higher, as I mentioned, as crude stockpiles in the largest U.S. storage hub dropped to the lowest since July of 2022. We've got ExxonMobil up 2.1%. BP, the ADR's up 1.8%. Chevron up 1.7%. EOG Resources up now by just about 2.7%. Pioneer Natural up 3.5%. Again, recapping. Stocks lower. S&P down 13, a drop of 0.3%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
It certainly is. Charlie Pellet, thank you so much. We appreciate it. Matt Miller, Paul Sweeney, live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube. So head to youtube.com and search Bloomberg Radio or Bloomberg Global News, and that'll get you where you need to go. As Charlie was just reporting, red on the screen today. Let's see where the action is. We check in with Abigail Doolittle. She covers all the markets for Bloomberg Television and Radio. She joins us here in our Bloomberg Interactive Broker Studio. Abigail, what are you looking at?
So the small gain that we were looking at earlier, well, it's turned into a small decline for the S&P 500. So we now have the S&P 500 down, I believe it is 6 of the last 8 days, or maybe that's 5 of the last 7 days. But in any case, the majority of the recent days are down. The S&P 500 at down 0.3%. The light volume we were talking about earlier, it's still below average, but by only 5%, which suggests that this little bit of selling activity we're seeing, the sellers are serious. Earlier, I talked about the idea that the sector composition was a little bit risk on. That has shifted completely. We only have 3 sectors higher, and it turns out that utilities, healthcare, and staples down really didn't help out the picture. I think that what investors are looking at, that 10-year yield, right now it's up about 5 basis points. It's quickly at 4.58, climbing quickly on what we were talking about earlier, just to reference the 10 o'clock hour, which is higher for longer. I think that's what we're going to be talking about for a while.
All right, so what else are we looking at? We're waiting for, I guess, a little bit of data. We're waiting for a government shutdown. We're watching the strike. What's going to be the catalyst to move us?
I think that there's not going to necessarily be that kind of a clean catalyst. I think it's more this macro backdrop. I think that the catalyst really is investors watching yields. One catalyst, what could turn out to be a bullish catalyst, could be if yields all of a sudden started reversing lower, and we saw, the 2-year yield or the 10-year yield drop by 10, 20, 30 basis points. A catalyst that could happen also from a macro standpoint that will be a pivot point either to go higher for stocks or lower. The S&P 500 hitting that 200-day moving average, I really believe at this point that that's going to happen. It's just about 50 points away, a little bit below 4,200 on the S&P 500.
On Friday, we get PCE. The Fed's preferred
that's a big one.
Inflation.
And something worth noting on PCE is, so everybody's talking about the idea, or there's, been about bond traders who've just been very wrong, and I give them a lot of credit because it can't be an easy seat to be in, but they've not listened to the Fed essentially for the last year and a half. PCE.
You've been so wrong. You're awful at your job, but damn it, do I respect you.
Well, I want to respect because it's we don't know what it's like to be in that seat, but the Fed is very clearly telegraphed. If you listen to what the Fed said and you were a bond trader, you'd be doing great. But most bond traders didn't do that. I think last year at the end of the year, we had a profile piece on 2 credit shops that did exceptionally well last year, and they both said, we listen to the Fed.
Yep.
Most are not doing that. But relative to PCE, what we're looking at there, and I'm just quickly looking for this here.
The core deflator year over year is expected to come in at 3.9%,
which
month
actually,
over month 0.2%. So 0.2 a month over month is fine because
why am I showing 3.7%? But in any case, it's lower. It's lower than or higher, excuse me, than CPI, and that's been the case for a while, where CPI is significantly lower than. Do I have something?
You're looking at the core PC price index quarter over quarter. That's coming on Thursday. If you scroll down a little bit and look at Friday,
this is how the sausage is made.
There we go. Okay, yes, there we go. Thank you so much. And so the prior was 4.2%, and CPI is well below both of these estimates. And I think that that's a great reason to believe that why the Fed is saying that they're staying longer, higher for longer, and that there could be another hike. They don't want to repeat the 70s, and so their preferred measure here, PCE,
70s are pretty good for me.
Oh, why? What happened? Did you have like a Camaro or?
No, just a good decade,
Camaro.
Solid decade.
Went to a lot of Zeppelin shows.
Did you?
Of course.
You did?
Sure.
At Madison Square Garden?
No, the Spectrum in Philly.
Wow.
Were
they incredible?
Very cool.
Yes.
That's my favorite band, by the way.
Oh,
I did meet Robert Plant.
Wow, that's a good one.
Yeah.
That's cool. My brother met Robert Plant and instantly shared it with everybody he knows, Very cool.
Yeah.
I didn't take him as a Zeppelin fan. Hey, let me just finish up here. If we're in a range, if this stock market is range bound, is that from a technical perspective? That's not such necessarily a bad thing, is it?
So I would say we're no longer in the range. The range is broken to the downside. The range was, and I'm waiting for my chart to pull back up, it was basically between, on the low side, 43.35, and then on the high side, 4,600 or so. So what's important about a range is not actually the range. It just signifies a total lack of information, chaos, a battle between the bulls and the bears. What's important is what way the range breaks. Right now, the range is breaking to the downside. If it does a full break, that will be, it's below 4,200, frankly. It's actually, it would be closer to 4,000, frankly. If this range breaks all the way to the downside, we're looking at a move toward 4,000. So what this suggests right now, and you do have the year-to-date uptrend broken, it suggests that the sellers, despite the fact that we're in this air pocket of information not really having anything, the sellers have more confidence that the information that does come out, whether it's PCE, jobs next week, ISM, the Fed in November, the earnings report, that it's going to be more on their side. It's going to be more supportive of selling.
But I'm not even going to look at it because I've lost all respect for it, the WIRP function.
The work. Well, thank you. See, now you back up my view on the bond traders.
Talking your talk.
How can you not? It's been back. Thank you. Yes, you're talking my talk. This year, it has flipped so many times between cuts, no cuts, no cuts. But the idea that they're pricing in cuts when the Fed Chair Jay Powell has clearly said that we are not cutting for years.
I don't know.
Next year is not years; it's a year. Let's just be precise about this.
I'm with you.
Yeah, so
but you know what? Powell is singing a different tune than the dot plot as well. He says it's going to be years before we cut, and the dot plot has 2 cuts in next year. So
dots go.
I mean,
yeah, I'm on there now. Well, that's an excellent point, Matt. That's an excellent point. So that tells us that Powell is doing a little bit more jawboning than
exactly, because
even...
dots are, you put your dot. That's your forecast. That's not, you're not jawboning the market with your dot. You're saying what you think is going to happen.
Yes,
yeah.
That's a great point. The one thing I would say is, in terms of the outlay of next year's dots, you could quickly see that whole structure move up. So that 3 dots, instead of being at like 545, I would say it definitely, he's trying to inform investors that conditions are tightening, but I would say the dots could follow him.
I mean, we're watching conditions tighten as we speak. We're now at 458.50 on the 10-year yield. The Bloomberg Dollar Index is at 1271, really 1272. And this is tightening conditions.
Yeah, absolutely. That's, I mean...
Let's get to Abigail, first of all, thank you very much for your market commentary here. Appreciate that. Abigail Doolittle covers all the markets for Bloomberg Television and Radio. Let's ask somebody who does this for a living, Matt, kind of what's happening out there.
Jerry
Kudzel. He is a generalist portfolio manager at TCW. Jerry, I look at my Bloomberg Index browser, and I did have some positive returns across the fixed income space for most of the year, but other than the high yield space, it's all negative here. So another tough year for the fixed income space. What's your call on this market?
Well, it's been a tough year for fixed income, unless you've been invested in leveraged loans or in CCC credit. If you take a look, the lowest quality portion of the credit markets have actually outperformed the most. I mean, you have CCC leveraged loans up 15% on a year-to-date basis. You have CCC high yield bonds up 10%, the high yield index up 5%, but you have leveraged loans up almost 10% in a rising rate environment. That's obviously to be expected. So you can find some positive return in the marketplace, and I think the credit markets are one place where you can find that. I think as you look at the Treasury market and you look at some of the volatility, and you've referenced it. I mean, the changes in WIRP and how data dependent the market is ultimately has created a little bit of people are a little bit seasick, I think, trying to figure out which way the Fed's going to go, and kind of hinged upon every piece of data that's announced on a daily basis.
But I guess this soft landing narrative has really taken over because you're not getting paid that much for junk. You're not getting paid that much for CCCs.
Yeah, I think that's a good point. I mean, I think the soft landing narrative, and honestly, it's a bit reflexive in nature. This takes hold, spreads get tighter. Some of it's a reflection of fundamentals and some improvement in corporate balance sheets, and some of it's a reflection of higher prices affirming what the market is already thinking. But corporate spreads themselves aren't really attractive. As a matter of fact, they're through historical means and medians, and I think as you think about the percentage of spread that you get as your yield, which I think is what you're alluding to, ultimately, whether you're looking at the investment grade portion of the market, high yield, lower quality, there's been a real compression in spread throughout the year. One area where you haven't seen that, I mean, corporate credit has, and one area where you haven't actually is in the agency mortgage market. And so there's something for everybody in the markets today.
Well, my inside credit trader source tells me that LQD is at a 22-cent discount. First time we've seen it since March 2023. LQD is the investment grade corporate bond ETF by iShares. So it does look like everybody's piled in, right? Is it time to sell?
I would say what we've been doing from our portfolios is reducing exposure from the corporate credit side of things. I think largely, kind of broadly, I think if you were to take a look at what we're doing, I think you're supposed to be reducing corporate credit exposure, especially on the investment grade corporate credit side, which sounds ironic given up in quality. I think late cycle is just kind of our view. But ultimately, we think you're supposed to be reducing across the board. We don't think spreads are attractive. Now, we would say we have this argument all the time. Really, the tug of war here is the difference between price and yield and spreads as you look at corporate credit. And I think where we're seeing inquiry and demand and flows is really just due to this kind of absolute yield buyer.
So if you're moving out, where are you more constructive on the market here, or is this just pulling some risk back here broadly across your portfolio?
It's a good point. I think there's a few areas. I think intermediate corporate credit, you don't take on, you can take on a little bit of duration, get just about, if not all, the carry. By the way, if you look at the intermediate, really interesting. If you look at the credit index relative to long credit, you get the same yield, and at the end of the day. So depending upon how constructive you are on duration or not, you can shorten your portfolios and get the same yield just staying in the intermediate corporate credit part of the curve in the investment grade land. We do think agency mortgages are attractive. If you take a look at spreads historically, they're sitting at all-time wides. You depending upon how you think about that marketplace, some of those agency mortgages are already fully extended. You're not going to deal with negative convexity in the lower coupon part of the marketplace. And then there's pockets of still in high yield and leveraged loans. I say we're reducing exposure there kind of broadly, so we're not adding. But we would say idiosyncratically, there's some opportunity there as well.
What's the new issue market like? I'm sure if I want to go out and sell some bonds, you're one of the first phone calls I make. What's the new issue market like?
It really depends upon the part of the market you're talking about. The investment grade corporate market, there's been about $1 trillion of issuance on a year-to-date basis. That's unchanged. It's fairly wide open. When you think about high yield, that issuance is up on a year-to-date basis, as is leveraged loans. And there's really a different story there depending upon where you're looking. But in the leveraged loan market, a lot of that's been refinancing, so not a lot of activity related to M&A, and that's been really the story. Is there's been significant kind of M&A activity and issuance around that in the leveraged finance markets that hasn't happened on a year-to-date basis, and I'd say that's a little bit of the story, and that doesn't really even speak to kind of the growth and proliferation of the private credit markets and what it's meant for the leveraged finance markets.
Just 30 seconds. What is your call on the private credit? That seems to be such a fast-growing part of the marketplace.
Yeah, I'd say we think private credit is here to stay. I think we think it's a formidable asset class. Hard to say it's not. It's well over $1 trillion at this point. Ultimately, there's been a lot of private credit that's been created in the last decade. I think what we would say is wherever you see growth like this and excess created like this, there's probably going to be volatility. We think that'll be opportunity on the back end of that, but we wouldn't be surprised if we saw a bunch of defaults or accidents in private credit, which ultimately led to healing and kind of a private credit 2.0, which is a more well-established platform ready to deal with defaults and more ready to deal with volatility.
Hey, Jerry, thanks so much for your time. Really appreciate getting a few minutes. Jerry Kudzel, generalist portfolio manager at TCW, getting the latest call on all things fixed income. This is Bloomberg. Let's get some corporate news right now. Lisa Mateo, company news.
Paul, we're getting more of a reaction to the FTC lawsuit that accuses Amazon of monopolizing online marketplace services. Here's Terry Haynes of Pangea Policy.
Once markets understand that what the FTC is up to is really not fundamental, firstly. Secondly, what markets understand that other Trump regulators at the FCC and the SEC are really engaging in a lot of performative conduct to say they're trying to do something without having the ability to back it up in court. I think markets are going to end up reacting quite positively.
Now, FTC Chair Lena Khan stopped short of calling a breakup for Amazon, but said that her agency would ask a judge to halt the company's, quote, illegal conduct if its antitrust suit succeeds. Shares of Amazon right now down about 1%. To entertainment now, where shares of AMC are higher after the movie theater chain said it's expanding its screening of the Taylor Swift concert film to more than 100 countries. Bloomberg's Katie Greifeld says AMC could use some good news.
Remember, the company announced plans to sell up to 40 million shares earlier this month after getting those court approvals. That has shares down 37% this month alone, and not a single analyst tracked by Bloomberg has a buy rating on the stock.
Now, shares right now are down about 2%. And streaming video providers are joining forces to form a new trade group. Netflix, Disney, Warner Brothers Discovery, Paramount, and others, they've created the Streaming Innovation Alliance, and that's to promote their interests to politicians and government officials. Missing from that list, though, Amazon, Apple, YouTube, and Roku. I'm Lisa Mateo, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 12:21 on Wall Street. We do check markets all day long at Bloomberg with the Dow, the S&P, and NASDAQ in the red. Stocks have resumed their slide as investors contemplate the prospect of higher rates and a looming government shutdown. S&P 500 index and NASDAQ both edging lower as oil jumps to a one-year high. West Texas Intermediate crude up 3.7%, $93.75 a barrel. Brent, $96.78 barrel of Brent up by 3%. The Dow is now lower by 194 points, down 0.6%. S&P 500 index down 19, drop there of 0.4%. The NASDAQ Composite Index is down 47, a decline of 0.4%. Spot gold down 1.2%, $18.77 the ounce. 10-year yield at 4.58%, with a 2-year now yielding 5.10%. Target is announcing that it is closing 9 stores in 4 states to stem losses from rising retail theft. 1 Manhattan location will be shuttered, along with 2 in Seattle, 3 in Northern California, and 3 in Portland. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate it. The S&P 500 year-to-date is up just about 11%, but that old SPW, the equal-weighted, flat, maybe even down a smidge. How about that? So we've got some issues brewing there because we've had a tough couple of weeks here. Let's see where we go from here. Our next guest can help out. Brett Ewing. Brett is a chief market strategist at First Franklin Financial. He joins us via Zoom. Brett, thanks so much for taking the time here. Again, kind of a tough correction we're in here for these markets over the last several weeks. What's your outlook?
Yeah, I mean, we've been through, I think, a pretty rough August and September here. I think we're down over 5% in September already. But look, I think a lot of the market got a little bit of ahead of itself going into early August, and I think we're in a pretty normal correction right here. I look back over the last 3 years, and it's kind of interesting. You know, September of 2020, the market was down 4%. September of 21, down 5%. September of 22, down over 9%. And in all 3 of those instances, we ended up with a pretty significant fourth quarter rally averaging about 9.8%. And that's the camp I'm really in. I think we're about to go into earnings, and I think we're going to hit a new high for the year in the fourth quarter.
Oh.
So what drives earnings? I mean, is the consumer still the strength?
I think the consumer is holding up tremendously better than anyone expected to coming into this year. I think there's a lot of headwinds for the consumer right here in the short run. I mean, look at oil. We're hitting a 52-week high as we speak. We have the student loans coming back online here this month, which is going to pull some money right out of the economy. And inflation is still pretty hot. So the consumer is definitely, in my mind, going to cool off a little bit, but still maintain a pretty good presence out there.
So what are parts of the market that you guys like right here, Brett? If you think we've got this market moving higher, how are you guys kind of playing it?
Well, I think the some of the large cap tech stuff is, I mean, it's had a nice pullback here. It's actually, as of yesterday, had went into correction territory with a 10% correction. We are looking a little bit in some of those areas, but mainly we're looking at the small cap index.
Oh, nice.
You know, there's a lot of value out there. I think, you know, the average stock right now in the Russell 2000 is, 30% off its 52-week high. And I think that's the area that we're really focused on right there.
All right. One of the names that I know you guys like, Floor and Decor, FND is the symbol. What's your call there?
Floor & Decor is just one of the best retailers out there in the market. I mean, I think their stock price is proving that. Over the last decade, they have compounded on revenue and earnings at over 30%. And going forward, we expect the next decade to be close to 20 to 25% as well. But they have around 200 stores, and they are the largest wood floor supplier out there. They sell more than anybody. You know, the tile and wood flooring areas are very fragmented with mom and pops out there. And they're going in, they're having very thin margins. They go in, they spend about $8 million to open a store in these fragmented market areas, and they're just taking market share, not only from Home Depot and Lowe's, but they're putting the mom and pops out of business, very much like Home Depot did in the early 80s.
Interesting, because I didn't even, you think about that market. I didn't even know about this company, Floor & Decor.
Yeah,
But you got to have it, right?
Yeah.
$9.5 billion market cap company. It's up 27% year to date.
Another one that you like is Alarm.com. It provides interactive security solutions.
Did I take that public?
Did you take that
No.
public for home and
No, I'm
business
saying
owners?
You put a .com on you, and I just wanted to
Okay,
check.
so software as a service. It's a SaaS company, Paul. that's what
that's
the new
the new-
kids
that's the new .com,
are
okay.
doing. But it's been called a monopoly by Honeywell, and I don't think you could get any finer compliment than that, could you?
It's a beautiful compliment, no doubt about it. Again, under the radar, small cap, mid cap company, however you want to frame it. But
$3 billion company.
Right. So, I mean, they're just dominant. We call this a moat company. If you look how they distribute. So if you think about the security market, it is super fragmented out there as well with a lot of smaller regional firms. But really, Alarm.com is the background of all of these security companies. So when you pull up your app, it may say, XYZ security company, but it's Alarm.com that's really running that. And they're not only do they do the SaaS service, but they do provide products as well.
Are there parts of the market you feel more comfortable with right now? I mean, you mentioned small caps. I mean, are you in the point where you're kind of trying to look for maybe some of these names that maybe are not as well known, like a Floor & Decor?
It looks
Alarm?
like you like fragmented markets where somebody can go ahead and take a big share.
I do like that. I'm not going to disagree. We like companies with some good moats around them. I think we're hitting I think the longer end of the yield curve has moved very quickly up here. It's putting a lot of pressure on these markets. It's really spooking the market right here. We've got some inflation numbers coming out on Friday, the PCE. I think that's one of Powell's favorites. Indicators when he looks at that. I'm focused on the core. We're expecting it to come in at 0.2. We also have all of October inflation data to come out. And I think that we're going to switch away from whether it's a debt, government shutdown stuff, which we will navigate through that. I'm pretty comfortable with that. We've got a strike going on. We got oil hitting. I think oil's peaking out right here. I think the treasury yields are peaking out right here. I think the dollar's peaking out right here. And I think all these trends are going to reverse here in the short run, leading to a massive rally going into the end of the year.
Ooh, I'd like to hear that. Because, I would say that, as you could probably imagine, the feeling out there is really kind of gloomy in the context of, the S&P, the SPX is higher this year, but the sense out there is more gloom, it feels like.
I love that sentiment right here. It makes me feel more comfortable in the new bull market. And this bull market started back in October of 22. And we rallied up 27% from the lows there.
Yep.
I'll give you a really good stat for your listeners. There's no time the prevailing index in history has ever rallied 25% straight off a low and that not be the low set in for the new cycle. And so going forward, I believe we're in a new bull market. And I think we're just in a normal correction right here going into the seasonality of September. And plus you have those rates, and like I said, oil and the dollar pushing up.
Brett, are you based in Tallahassee?
We are based in Tallahassee.
So I have to ask the question, is Florida State back?
Florida State is back. Let it be heard. We have an incredible coach. Norvell is doing a wonderful job with the team. He's doing excellent with recruiting. We just have a good makeup going on right now with Florida State football.
Yeah, I mean, it seems like you guys for such a long time, you and University of Florida and Miami at the same time, none of those Florida kids got out of the state. But so I guess the challenge for anybody is to kind of keep that talent in state, right?
That's right. That's right. And there's a lot of competition, a lot of coaches fly down to Miami recruiting, no doubt about it.
So, all right, speaking of just Florida in general, everybody has left New York. Matt and I are the only ones left. I mean, are people still coming down to Florida? Is Tallahassee, how's the economy down there in Tallahassee?
The economy is excellent here in Tallahassee, Florida, just as it is all over Florida. Unemployment rates, one of the lowest in the country. Yes, housing is through the roof. People are moving here still in groves. And believe it or not, Tallahassee is picking up some of the transplants from around the country. There's zero inventory. I mean, there's just the lowest inventory I've ever seen in real estate in Florida right now.
And I guess the call is you guys don't pay state taxes down there.
We do not. We are very blessed.
Well, how does that happen? Because
why don't we have that?
Yeah, why don't we have that? Yeah, I mean, we're getting taxed through the nose. All right, Brett, thanks so much for joining us. We appreciate it. I guess it's for all the snow removal that we have here that they don't have.
I pay more taxes here than I did living in Berlin, in Germany. In a socialist country, I paid less in taxes of my income.
All right, Brett, thanks so much. Brett, he's the chief market strategist, First Franklin Financial down there in Tallahassee. Appreciate getting some of his thoughts. But, I mean, that is pretty sweet. I mean, no state taxes.
Yeah.
They got to get you somehow, though, don't they?
On the other hand, do they have high humidity? It's and not a lot of curvy mountain roads, you know.
No, but it's flat.
I think I would like it. I think I still would like it.
They got the ocean, the Gulf.
We should go, Paul.
All right, it's a great place to visit. That's how I play it. All right, let's head down to Washington, D.C. right now. We're going to do Nancy Lyon. She's got world national news for us.
Thanks, Paul. The second Republican presidential debate is set for tonight at the Ronald Reagan Presidential Library in Simi Valley, California. 7 Republicans have qualified for this one, but the GOP frontrunner Donald Trump will not be there. Instead, he'll be in Michigan, working to win over blue-collar workers in the midst of the auto workers' strike. He'll be speaking, though, at a non-union auto parts supplier. His trip comes a day after President Biden became the first sitting president to walk a picket line. The union is pushing for higher wages, shorter work weeks, and assurances any new electric vehicle jobs will be unionized. Well, the U.S. soldier who crossed the DMZ into North Korea 2 months ago is back in U.S. custody. Bloomberg's John Herskovitz is in Tokyo and explains what happened back in July just before Private Travis King rushed across the border.
He had been held in South Korea for some charges, including assault. He was released from custody in South Korea and was going to go back to the U.S. to face expulsion from the U.S. military. Instead of going on a plane back to Texas where his base was, he went on a tour to the border between North and South Korea in the Panmunjom Truce Village.
Bloomberg's John Herskovitz says that's when King ran into North Korea. His fate, though, remains uncertain since he was declared AWOL by the U.S. government. U.S. astronaut Frank Rubio has successfully landed in Kazakhstan after breaking the record for the longest continuous space flight by an American. He spent 371 days in space. NASA's Rob Navius with the play-by-play.
Touchdown confirmed at 6:17 a.m. Central Time. Rubio's record ride comes to an end.
Rubio's stay was extended on the space station by 6 months after the original spacecraft suffered a leak and forced them to use a replacement to bring him home. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 12:40 on Wall Street. We do check markets all day long here at Bloomberg with the Dow, the S&P, and NASDAQ all trading lower. The S&P 500 index and the NASDAQ 100 index are moving lower as oil jumps to a one-year high amid dwindling crude stockpiles, stirring up worries about the health of consumers. West Texas Intermediate crude now up 3.8%, $93.88 a barrel on WTI. Stocks lower across the board right now with the S&P 500 index down 16 points to 42.58, a drop of 0.4%. Dow Industrials down 168 points, lower by 0.5%. The Nasdaq Composite Index down 40 now at 13,023. That is a drop of 0.3%. 10-year yield 4.58% with a 2-year 5.11%. Spot gold down 1.4%, $18.76 the ounce. As for the overall market backdrop, Dennis Gartman is chairman of the Endowment Fund at the University of Akron, and he was a guest this morning right here on Bloomberg Surveillance.
On a scale of 1 to 10, I'd say I'm probably an 8 or 9 on the bearish side at this point. I think we've seen the highs for the year, and I think that high tech is going to be the leader to the downside. It won't be dramatic, and I think what we see is that the market continues to go down on big volume and rally on light volume. I think that's a signal of internal weakness, and I think that prices want to go lower.
And you can hear more of that conversation on the Surveillance podcast. You can download it wherever you get your podcasts. The NASDAQ 100 index right now down by 0.2%. The auto workers' strike dragging on, with workers fighting to get back their once sacred retirement pensions. Ford, GM, Stellantis all determined to consign pensions to the past, even as striking UAW members aren't just as keen to revive them. Ford shares down now by 0.9%. General Motors down 0.2%, and Stellantis lower now by 1.1%. Recapping a lot of red on the screen, S&P 500 index down 13 now, a drop there of 0.3%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Charlie Pellet, thank you so much. We appreciate that. Matt Miller, Paul Sweeney live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube, so head over to youtube.com and search Bloomberg Radio. Well, we here in Bloomberg Radio and TV, the media side of Bloomberg, we're here every day. We're required to be here every day. And there are a lot of people in Bloomberg Radio and TV that did not miss one day during the pandemic. They came in every day to get the shows on the air. But we are clearly the exception, not the rule. It seems like this hybrid work is here to stay. Let's see where the latest findings are. Eileen Mullaney joins us. She's a workforce transformation lead at Vialto Partners. She joins us via Zoom. So Eileen, is, I guess, hybrid work, is that the new normal going forward?
That is the new normal. And first, thank you so much for having me. Yes, that is the new normal. I think what we're seeing in a lot of industry sectors, though, is this combination of really hybrid work. There really is a big focus on return to the office. So we definitely are seeing that. I think in the height of the pandemic, we never thought we'd see return to office. We thought we were fully remote forever, but there has been a big push to get people back to the office. And I think 3-2 or 4-1 is the most common schedules we're seeing.
I mean, there are a lot of folks, it seems like a lot of industries, a lot of companies. I'm thinking of the financial services industry. I'm thinking of the Jamie Dimons of the world that are pushing still for 5 days a week. But they feel like the exception rather than the rule here.
I think we're not seeing as much on the 5 days a week, though. I think there is a lot to be said for human interaction, collaboration, more than you can do just on Zoom. So I do see a lot of focus on that, especially when it's very junior staff, young staff that perhaps have not developed their professional network. And that really is a plus to be in the office and just see how things get done. Also, some of the challenges with developing relationships with new clients, new customers, can often be difficult if the relationship is purely video-based and not really in person. So I think for me personally, the hybrid is kind of the best of all worlds. But I do think there are some CEOs, some companies in particular, that are really trying for that 5 day a week work in the office. But we have seen employee expectations have significantly changed coming out of COVID.
Yeah, I have two 27-year-olds and a 25-year-old in the workforce, my offspring. And to them, coming in 5 days a week, it's not even something that's in their mindset. And I kind of feel like this generation, it's just a non-starter. Is that kind of how it seems at this point?
I think it certainly feels like that sometimes. I think that a lot of them started their career in COVID, so it's all they know.
Yep.
But I think, and some of them do have an expectation when they do come into the office, kind of what's happening that day. Is there something exciting? Is there, a happy hour? Is there a lunch? What's happening? Why do I need to be in the office? And I think it's because they haven't seen the benefits of that kind of collaboration full time. So I think that's the important message to get to all of them, for sure.
When this whole thing started, I just saw no way that this economy could function efficiently with everybody working from home. Like I thought, when, for example, just in the business that I'm in, Wall Street, I couldn't imagine traders trading as efficiently and as successfully from home as they do in the office. And they've got all this computer screens and all the technical tools. But they did, and the economy did, and the global economy did just well. I mean, it's just really shocking how it really played out.
I was one of those that thought, oh, this will be in place for about 2 weeks and we'll get back to normal. I kind of shared the same opinion that it was going to be hard to really shift to being productive, efficient, and just continue on as if this was a normal. And none of us were really prepared for it, and none of us were really trained properly for it. It's different with organizations now. They're doing a lot of focused training on helping managers understand how to really manage a workforce that's not in the office, how to kind of look at social cues on video, all different kinds of training that we had never thought of putting our teams through before COVID. So certainly a lot more aids and tools to help people. But I agree with you. I don't think we all expected it would be quite so successful without any planning or training, for sure.
I think one of the unintended consequences, but something that people are starting to think about now is this kind of creating a divide or exacerbating a divide between those people, we'll call them essential workers, that have to be in, whether it's on a factory floor or in a fast food restaurant, and those that don't, and those that actually have the flexibility. How big of a problem is that now, and could it evolve into?
It continues to be a problem. We certainly saw it as a lot of organizations started to design their future of work programs. And this was during the height of COVID when, as you said, those essential workers had to be at work 5 days a week and everybody else was at home. And I think companies still really struggle with what kind of peer equity do we want to develop? What kind of culture do we want to develop for the organization when there's definitely in a lot of industry sectors, a lot of companies, very distinct workforces, a part of the same organization. And it's very challenging to come up with policies that are viewed as equitable across the board for everyone when certain roles and even certain locations just have a bit more flexibility than others. So I think that tension is here to stay for sure.
And I wonder if that's kind of driving to some extent some of the strikes that we've seen, worker strikes, whether it's the UAW or the actors and writers in Hollywood or the UPS drivers. I'm guessing a lot of those folks are saying, I need to get some now. I mean, I was an essential worker. I made the big commitment. I took the risk. Now I won something.
It's hard for me to comment on those. I'm not part of any of those unions, but I can say for the organizations that I work with across the board, flexibility is a critical design feature more than it ever was before. And it's interesting when companies think about flexibility for their workforce, they think about it in two parts. One, employee flexibility, where the employees can work flexibly. And that doesn't always mean I get to work at home, but it could be more creativity around the shifts they have to work or how much time off there is. So I think that whole kind of creative approach, it's not kind of business as usual when we're thinking about designing policies and approaches. And then on the other hand, there's also flexibility for the managers to be able to have a little bit more autonomy in the decisions they can make and the arrangements they can approve for their team members.
Right. It's a whole new world. Everybody's adapting, it seems like. Eileen Mullaney, Workforce Transformation Lead at Vialto Partners, talking about the new workforce. It appears to be for most organizations some form of hybrid. And I guess a lot of folks are still trying to work that out. But whether it's 3-2 or 4-1 or something different, hybrid seems to be the new normal. We're going to have more coming up. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Thanks, Paul. CVS pharmacists in Kansas City, Missouri plan to resume walkouts to protest working conditions. Bloomberg's Fiona Rutherford explains what led up to the job action.
It was a build-up of frustration from the pharmacists there. Things had reached a tipping point, according to people I'd spoken to who were aware of the situation. We're in vaccine season, so the pharmacists had a lot to do there, and there were a big shortage of staff.
As sources tell Bloomberg that the company also reneged on a promised public apology. The pharmacists are not part of a union. Shares of CVS right now, they're down about 2.5%. And Costco didn't say when its membership fees could increase, but it did highlight an earnings beat. Bloomberg's Simone Foxman said it was a mixed bag.
Earnings per share beat analyst expectations, coming in at $4.86, but comp sales coming in a little bit weaker than anticipated, especially when you include the impact of currency and gas. Overall, we're looking at 1.1%. The street had been looking for about 1.8%, especially seeing a little bit more weakness in the United States. The company's saying it's seeing those customers trade down big ticket items. Purchases still weak.
Now, shares right now up about 1.5%. And the U.S. Federal Trade Commission typically drops challenges to deals when they lose in federal court. But apparently Microsoft is an exception. The agency is reviving its challenge against the tech giant's $69 billion acquisition of Activision Blizzard. Now, the move means the FTC will continue challenging the deal even after it's closed this year. Microsoft right now down a fraction. I'm Lisa Mateo, and this is Bloomberg.